Hi, it's Aoife Devitt, and welcome to today's Markets Happy Hour podcast. I am recording this in the sunshine on Friday morning, May 22nd, and it's going to be a slightly shorter than usual podcast due to travel logistics. So let's kick off the slides. I've called today's podcast Ships Passing in the Night, as it was indications that two ships had passed through the Strait of Hormuz. That was what gave rise to the market rallying in pretty strong fashion this week. And what we are going to discuss in this podcast is the stark contrast, besides the exuberance in equity markets, between the stark contrast between that and quite calamitous selling in the bond market when it comes to duration. So I'd say these two things, these two forces in markets really represent two points of view, which seem to be coexisting. And it is now our task to determine whether one will influence the other or whether we're going to have this cognitive dissonance persist for some time. As usual, we'll cycle through inflation, interest rates, geopolitics, equity markets, and other asset classes. And the subtopics for today, we will discuss how oil has moved as the ships have in the opposite direction, as it turns out. We'll speak about the bonds that are flailing. We're going to talk about some of this fast track IPO race, this race essentially to get public by three companies right now, SpaceX, OpenAI, and Anthropic, which seem to have really accelerated their push to go public, perhaps sensing that this is the moment in time in order to capitalize on the enthusiasm. We will again look at AI and other drugs in terms of some of the attachment that's being attached to these, as well as the movements in markets resulting from some of the recent news flow. Starting with the sort of a sub-inflation theme, because we've spoken about the move of oil prices as ships have passed in the night. We've known also that there seem to have been prospects of a more long-term US-Iran peace deal, and that has led to oil falling. And even though it says here in the headline that equity markets across Asia were mixed, there has been generally a positive sentiment emerging from that development in oil. And the oil drop was in fact nearly 6% when two of the tankers that had crossed the Strait of Hormuz were bound for China. So this bringing it to about $105 a barrel. Nothing that will be felt at the pump just yet, but definitely moving in the right direction. And we should note that even when there is a resolution of the Strait of Hormuz situation, there will still be many months of disruption, backlog, as well as supply chain logistics constraints that are likely to ensue due to these closures. So it's unlikely to be like flipping a switch in terms of everything going back to normal, but the market certainly is building in some optimism regarding that at the moment. Moving on to other economic vibes. So we have continued to see the really near daily now, multiple almost repetitive headlines around layoffs that are ensuing as a result of rethinking of organizational structures around AI. One of the latest was Meta, which had laid off thousands of its employees, 8,000 or 10,000, 10% of its staff. Again, to offset the cost of AI investments. And this is important because we are seeing mounting evidence that there are flat plans being abandoned, that the use of tokens has just been so momentous that there has not been the ability to keep pricing as it was originally. So the cost of AI is mounting. So it's not simply that AI is replacing these employees. In fact, it may not be. It's simply that there is a need to free up capital for these investments. And a point we make later on is that actually the saving around employees is very minimal compared with the massive capex spend that these companies have put in place. So the question therefore would be whether these layoffs will even make a dent in the expenditure needed for AI, and that is looking questionable right now. Other jobs outside the tech sector, we've spoken about Meta, Walmart, Morgan Stanley, all cutting jobs, mostly in the management C-suite seems to be where that those cuts are being felt most. The other big phenomenon of the week has been really an acceleration of this bond sell-off story with respect most definitely in the longer duration bonds, whether it's 10-year or 30-year. We have a 10-year chart here on the top left and a 30-year chart on the bottom right. In the case of treasury yields, highest level in more than a year when it comes to 10-year US government bonds. And then across other developed markets, we're seeing long yields, so at the 30-year, at their highest in decades, led in this case by gilts, which, as we know in the UK, have been really bearing the brunt of the political uncertainty in the UK. We're also seeing, though, that treasury yields, JGBs, all at this time reaching a higher level of sell-off. So the last time we've seen this type of a sell-off in gilts was back around the financial crisis, predating '08. This would be around the beginning, around 99, 98, 99. The equity market too is certainly shaping up to be an unusual one. We've spoken about how the stocks, particularly in the US, have generally rallied as news flow around the war has developed. We have seen the European stocks suffer much more than the US stocks. And if we look at a chart that compares stock movement with bond movement since the war, we can see that stock movement has generally shown a recovery, pretty solid recovery, and actually much more increase as we move through the uncertainty of earlier in the year, which, as we know, was relatively flat as it was anticipating some uncertainty relating to the war, whereas the Bloomberg Ag has also been ticking along fairly steadily. The semiconductors, on the other hand, have been the absolute breakout trade here. There has been, if we look at this, we've seen that they have really taken off as the infrastructure trade in the aftermath of much of the sell-off. But we can also see that the S&P itself has behaved quite respectably, but that there has been a story of a breakout trade within that sector. We're still referring back to the capex number, as this is something that is really extraordinary in terms of AI demand. So we do know that the AI demand is surging, but that across the board, we are now looking at hyperscaler capex, which could exceed 1 trillion in 2027. This is really the new calculus in terms of what companies need to have in reserve if the expenditure goes as we have expected. We can see that Alphabet, Amazon, Meta, Microsoft, these are all huge consumers of capex and users of capex. So we can see that this is likely to be a factor that is increasingly dramatic. Even though 2026 was already high, we can expect it to be even higher next year. This is the chart I was referring to earlier when it comes to the intersection between the cost of capex and the cost of people. This chart shows Alphabet, Meta, Apple, Microsoft, so 4 of those large companies that appeared in the previous chart. And we can see that even at this point, we can already see that the cost of people, as expressed by the blue line, has now already started to get flat, and capex has significantly overtaken that. So we do also know that the cost of the recent layoffs, particularly in the case of Meta, are quite insignificant when it comes to the capex spend that they have committed, when we can see here that the amount that Meta has committed is well in excess of 100 billion. It's expected that they will save approximately 8 billion from some of their current people cuts. So clearly not really making a dent in that capex spend. And this will be a new calculus that companies need to consider versus how expensive their people are versus how much they're likely to spend on capex. And what will be seen is whether other factors will also be cut as capex continues, or will capex be reconsidered as there will be a desire to see return on investment in the AI. I think at this point it seems to be indiscriminate investment without particular attention to the amount of return, whereas when there is going to be an increasingly lack of lowering of prices in AI, as we know seems to be the case, will there be a focus there more on return on that investment? We do hear a lot about the 100x employee. There are certain coders perhaps that have seen their power to generate product times by 100. I would suggest that that's a very rare employee, that it's still not the case that individual companies have found how to maximize, in fact, their use of AI resources. So I'd say a tremendous amount of uncertainty here and a desire to spend first, ask questions later. Another area where it looks like we could be spending first and asking questions later is in the case of the IPO frenzy. We know now in the last week that OpenAI is preparing to file for its IPO very soon, and that could be as early as September. We've also seen the success of this Cerebras company, which had raised 6.4 billion, signaling strong demand. And SpaceX has been bubbling along as a potential IPO for some time. And Anthropic now, it does seem that all 3 will be on this fast track. So far this year, it says there has been a strong start to fundraising. We can see that year to date, if we look at this bar chart, there still has not been that same degree of certainly if we look at previous years, say 2021 as an example of the deal value of the significant IPOs there. 2026 is trailing. We are only 5 months into the year with these three mega IPOs in the offing. So clearly quite a strong start. There is another technical question though, which is how passive investors will make space for these IPOs. There is a suggestion that there will be some dumping of other holdings as they make space for these IPOs. We've already spoken about how concentrated passive investors are and how much of their portfolio is represented by, say, the top 10 stocks. If they are making space for these new IPOs, will they be dumping those concentrated positions, or will they be getting even more concentrated in these stocks, which are essentially mostly levered to the same AI trajectory? They may well find that they are not only loading up on companies that are spending on capex, but also they are loading up on the object of that expenditure. So there could well be many unintended doubling up bets within those portfolios. So it remains to be seen as to how the large passive funds will move. And we're also seeing Asian markets still demonstrate quite a bit of strength. That has actually outpaced Nasdaq in the past in the past few months, and we can see that is actually getting very strong. And that is our abbreviated podcast for this week. Clearly, quite a bit to follow in terms of the divergence of bonds and stocks. We are also focusing very much on this frenzy around new equity heights being seen, as well as the IPO frenzy. And we are just reflecting as we come to the end of we're actually writing our report now for the second quarter, even though we still have 6 weeks to go. We know, looking back at 2025, a defining year for metals, we've seen very little discussion of metals or Bitcoin at the moment. The focus is very much on the good old-fashioned balanced portfolio and just exactly how that balanced portfolio is behaving. So thank you for listening to this abbreviated podcast. We'll see you for the usual length next week.